Hello everyone and welcome back to the channel. Welcome to Vertex Investing. Before I get anywhere, I just want to say thank you to everyone who's liked and subscribed our videos. Thank you for 2k subs on YouTube as well as 2k subs on Telegram. I think the rate that Vertex has grown is absolutely amazing. It's not what we expected when we first started, but I just want to say that we appreciate everyone that shows us that support and continue to show that support. It really does mean a lot. So in this video series, we are going to talk about market structure. Now, more importantly, market structure is fairly straightforward, and I have explained it before in one of the videos. However, there's something that I've realized that it's a recurring pattern, which is what most of you are sort of struggling with from what I've seen. This is based on the messages that I've received pretty much on a daily basis. This is a trade that I've actually taken this week. I don't know if I'll actually explain it. There was a breakdown actually in our free Telegram. If you want to have a look at it, it's from here. Also, if you like these posts, just let us know. I'm more than happy to do more of these, just to give you a bit of an insight of how we actually trade at Vertex Investing. So let's talk about market structure. So a lot of you are probably having this situation where you would enter a trade, for example, here. You get a break of structure, then you'll enter at this point, you get an OB, and then you'll go on and you see this very impulsive move. And then after that impulsive move happens, you either get taken out of break even or whatever, and then price continues. And you're probably thinking, why is that happening? Now, the reason why this is happening is because you're not understanding your range. Okay, range is everything, and it's something that I've keep going on about throughout this YouTube channel, because without understanding your trading range, you will really struggle, and you'll struggle with understanding what structures are actually important. Okay, the main thing to realize is that the way the market moves, right, in very simplistic terms, is that you get an impulsive move, and then you get a sort of a correction, and then an impulse, correction, impulse, right, until you get a change in trend and so on. Okay, that's essentially how the market moves. So with that logic, right, because as you normally get taught market structure, you get taught like this, right? You get taught that market structure for a bullish trend is higher highs and higher lows and so on. But what market actually moves like this? No market moves like this. Okay, the markets actually move as I've drawn up here. Okay, you have these really random moves, and that's how the market is, right? Now, because of the way that the market structure is actually portrayed in many courses, it confuses people to actually understand what's minor structure and what's major structure. And especially with smart money concepts, you need to be able to differentiate the two, because if you can't, then it won't make sense why you get taken out of break even, or why you have these big pullbacks at certain moments. Because let's talk about it in this sense, right? When you break minor structure, for example, sorry, I thought I had there we go. When you break minor structure like this, okay, and say you got an entry point here, you've got an OB, fair enough, okay, this is for those who are following, that simple break of structure, entry off an OB without any real reasoning, okay? And then say you enter here, fair enough, okay, that's I would say a valid entry in that sense. And then when you go on to break that major structure, you realize that you tend to get a pullback, and that comes back to your entry point. Now, by this point, because you've broken various structures at this point, okay, you've moved your stop loss to break even, right? And because you've done that, you've just got taken out, and then price will continue. Okay, not necessarily in that impulsive manner, but price will continue. But why is that? So let's talk about major and minor structures, right? So for example, when you get the first impulse, right? So the first impulse initiates from here and creates this, okay? When you get this corrective phase, which is here. Anything that is part of this retracement, okay, anything that's part of that retracement is minor structure. That's all you need to remember, okay? And your range play would be from that high to this low. So when any of these are violated, that violates the range, okay? But anything that's happening in between is minor structure. So essentially all you need to do it just follow your major structures that you actually have. Okay, and by doing that, you'll be able to catch the right pull. You'll be able to catch the right breaker structure and the right pullback. Because if you're getting these breaker structures here, right? If you're getting a breaker structure here, for example, you're entering here, you're going to be taken out because you're trading off minor structure, right? So understanding what range you are in, okay, will give you that edge of understanding market structure. And it doesn't matter what time frame you're looking at. It doesn't matter. As I said, it doesn't matter what time frame you're looking at. Exactly the same situation. Whether this is the 1 minute, whether it's your 1 hour, 4 hour, whatever it is, it still is going to happen. The same thing is going to happen. If you're trading off minor structures, be prepared to have this huge pullback. Okay, now that's what I realized, is that a lot of you are trading within these minor structures. Okay, and the issue is you're not able to catch the full trade purely because of the fact you're trading these minor structures. Now it's quite hard to sort of practice this and actually get used to it, but just what you have to do is simply go to the charts and have a look at your most recent trades and then compare the ones that you've taken break evens on. Now if that's the case, if you're struggling with this, just simply go, say for example this is the 1 minute. Okay, if you're struggling with the lower time frames, right, just go to a higher time frame that you feel comfortable with, because although you can you can be comfortable with the hourly time frame, 4 hour time frame, because you're comfortable with those time frames, it doesn't mean that you can instantly jump to the 1 minute time frame and be successful with it. Okay, it's a whole different dimension to understand what's your minor and major structures. In terms of the higher time frames, your minor and major structures are a bit more obvious. Okay, they're not. You won't really get this scattiness from the higher time frames. But when you get to the lower time frames, it's very hard to distinguish whether you're actually trading the main range or if you're trading inside a range. Okay, so the main thing to remember is when you're trading inside the range, what's actually happening is, so remember when I was talking about OBs, right? When you're trading inside a range, essentially what's happening is you have, so this is inside a range from here, so this is that, okay? You have this sideways movement. There's no clear direction in trend, which is fine because all we need to wait for is a violent move. And that violent move essentially breaks the actual structure, which is the major structure, right? Once that happens, what does that mean? What is it left behind? It's left behind that footprint that we are going to be looking to trade from, right? So if that's the case, because what happens is, generally when you get this first break of structure, because that's already violent, right? People start instantly looking for trades, which is fair enough, okay? You're more than welcome to, but say bear in mind it's a reversal, okay, in this sense. Remember, the first break of structure does not indicate that it's a change in trend. It can simply be a liquidity grab. However, when you get this break of structure and you have this sort of consolidation period, it's a good thing, okay? It's a good thing because it shows you that there's something going on in the market. It's where the buyers and the sellers are at an equilibrium, okay? The buyers and sellers are happy at this point, okay? There's no sense of direction yet, okay? And there's no footprint that's being left behind. All you have to do is simply be that little bit more patient, and by being that little bit more patient, you'll have this impulsive move, which will give you that first indication of where price is heading. Because once this happens, because you have to bear in mind the way that the market is actually running, right? The way the market is running, you're going to have period. If you talk about the market cycle in a sense, okay, in terms of the market cycle, let's do it like this. Actually, it's a bit more cleaner. So let's talk about the equilibrium period, right? At this point, should we be looking to trade? No. Why? Because there's no real sense of direction. Okay, when you have a break of this sort of consolidation period, say like that, that's your first sign. That's your first warning sign that it gives you an indication of what the institutions are actually doing. Okay, you have to bear in mind the institutions aren't necessarily against, well, they're not really against us. We're just a byproduct of the market being affected by the competition between the institutions. Because to be honest, we're not relevant in the market, okay, as retail traders. Regardless of whether we're using smart money concepts or not, we're not relevant, okay? As bad as that sounds, we are just a byproduct of the market in this sense, okay? Now, basically, essentially, what we have to wait for is after this break of this sort of consolidation period that is happening, it gives you the indication that the institutions are looking for higher prices. Remember, when there's a violent move, what is left behind? Okay, you're going to have imbalance left behind. You are going to have an order block as well. Okay, it doesn't mean that you simply trade straight off that order block. Okay, it doesn't mean that. However, that's your first indication of where you are looking to trade. Okay, because all you have to do now is step backwards and have a look for the footprint that's being left behind, and that's where your entry criteria comes into play. So at Vertex, obviously, we use our 2-rule mechanical process to enter these trades. So everyone who follows the 2-step rule will have the exact same entry. Depending on what time frame you use, you will generally have the same entry if you're using the same time frame, because the 2 rules are so, I wouldn't say they're strict in that sense, because you do need to allow for some flexibility in the market, but it allows people to gain that, it allows people to decide they're going to buy here at this point, okay, because there's only 2 rules to follow, right? That's where your entry criteria actually comes into play, and that's where the Vertex method actually benefits us really at this point. But that's your first indication that that's what you need to look for. Now, with that being said, okay, now that you've understood the bigger picture now, when you get a market like this, so you have an impulsive move, and then you have a corrective phase, and then another impulse. Now, take a step back, have a look at some of your trades and see, have you been trading within the range? And if you have, this has just corrected what you've been doing wrong this whole time. So what I suggest doing is taking your time and having a look at your previous trades and trying to understand why you've been going out, why you've been taking out a break even. Have you been entering too soon? Have you not been patient enough? Have you been entering during a consolidation phase, which is generally the pullback or a corrective phase in the market? Because bear in mind, the institutions, the only way that we know they're active is by looking for these impulsive moves. These impulsive moves are the footprints, okay? Whatever you do when you're using this strategy, you have to realize that there has to be logic behind every single step to your process, okay? You need to remember that. So if there's no logic between trading within the range, then why are you doing it? Okay, if you are doing it, you're most likely affected by FOMO at this point. So what I suggest doing is taking a moment, thinking about your previous trades that you've taken, and try see what range you're actually trading in. Are you trading the major structures, or are you getting caught up in what's happening in the middle? Because this is all noise, okay? This is essentially irrelevant in the sense that you won't be trading it. You just have to be that little bit more patient and waiting for that big impulsive move in the market, which is fine, because sometimes it can take a while, and that because it takes that long, it causes traders to sort of lose their mind and start trading within the range. However, the benefit of having 2 rules, especially the ones that we teach at Vertex, is basically it allows you to simply just be patient and wait for the 2 rules to play, because at this point the 2 rules haven't actually been met from this drawing here. But yeah, that's the benefit of having a rule-based system. And if your rules are consistent, it basically means your results are effectively consistent. The main thing to bear in mind is with smart money concept is basically another edge, right? It's same as any other strategy. Okay, it's not any better than any other strategy. You have to bear that in mind. Okay, it is an edge. It will have losing phases, right? Because we're trading, say, quote unquote, with the institutions, it doesn't mean that we are going to be correct 100% of the time, because we won't. Okay, there's no edge possible that will do that. Okay, and we need to accept the fact that although we are trading with institutions, okay, I'm not going to say that actually, but that's essentially the thought process behind it. But although we're doing that, it doesn't mean that we're going to be correct all the time. Okay, and that's something to bear in mind. So the strike rate with smart money concepts may be less, purely because of the size of the stop losses that we have are generally 5 pips or below. Well, our Vertex is generally about 5 pips or below, depending on your risk appetite, to be fair. But the main thing to bear in mind is the fact that this is an edge. You have to let it play out. Okay, so I hope that you've enjoyed this video, and I hope it's given you some insight into actually how to differentiate between minor and major structures. And what I'll do is a few more chart breakdowns within the Telegram group, so make sure you join that, where you can actually see where we actually enter. Now this entry was actually quite late, which I explained in the Telegram. But yeah, so essentially you need to understand where your major and minor points are, and the whole idea is the fact that you need to understand that price is already predetermined. Okay, that's the main thing you need to realize in the market, right? And all we are doing is trying to follow the footprints that the institutions are leaving behind. Okay, but it does not mean they will be respected. For example, in terms of the supply and demand, from a supply and demand point of view, what we can see is obviously a rally, base rally, right? So in that sense, we should get, in theory, an entry here. Obviously it wasn't respected, but we didn't have our two rules that we teach at Vertex present ourselves here. So what essentially does, using the Vertex method, it will allow us to determine which POI or which order block or sponsor candles or IFCs, IPAs, whatever you want to call it. It allows us to determine which one is the correct one. Now, by saying, okay, that's probably the wrong wording, but instead in terms of saying which one's the correct one, is basically I'm trying to say is it will help you determine which one is the higher probability one using the two-step process. And this two-step process can actually be repeated on any time frame. But the main thing to take away from this video is understanding the difference between minor and major structures. And essentially my main advice to you guys is try to avoid getting stuck in the noise. Okay, when these markets are ranging like this, or even like this, you don't want to be involved. You want to wait for that impulsive nature, and then that's your first warning sign. Like this impulsive move, for example, is grabbed all liquidity, and then you had the impulsive move, and that's when you'll start looking to get involved. And as you can see, like for example, this is very rough, but as you see, this impulsive move here, price has come back to this order block, and then, oh, why didn't I go there? Price has come back to this order block and gone, right? That would have been our first warning. That would have been our first warning sign to actually be wary of what the market is showing us, by simply following the sort of indicators of price that's actually going on in the market, right? So we don't want to be caught up in the noises happening in between. All we want to see is where the impulsive moves are happening and where they originate from. Okay, in very simple terms, that's all you're looking for, is looking for that impulsive move and where it's being originated from. That's simple as that. But for now, I'll leave you guys be. I hope you guys have enjoyed the video. Obviously, if you want to join the mentorship, feel free to visit our website at vertexinvesting.co.uk, where you can join either the mentorship, or if you simply want the course, program, you could join the course Discord for $97 a month, and you will not obliged to stay. You can cancel after the first month if you don't like it. It's completely up to you. But you can have you can basically have full access to our strategy, learn 2 rules, and you can go. Or if you want to join the mentorship and have full support from us, which is what we are proud of, what we are proud of, and what Vertex was actually created for, was the mentorship and that personal support. If you want that, then feel free to join the trade membership. Also, on the 20th to 21st of March, we are also running a 2-day live bootcamp. And if you want to join that, be sure to use the code M500. Let me put that here actually. M500 at the checkout, and they give you £500 off the bootcamp fee when you join. I hope to see you guys there, and I hope that you've enjoyed this video of the Smart Money Concepts Made Easy series. For now, take care and trade safe.